New Zealand's property market is on the brink of a seismic shift, with a staggering $300 billion in mortgages set to be refixed this year. This represents 81% of all home loans, creating a financial landscape unique to our country. We're joined again by real estate expert and best-selling author David Whitburn to dissect this mortgage tsunami and its implications for the property market. Dave was president of the Auckland Property Investor Association and continues expanding his 20 mil plus property portfolio. So he started with putting a minor dwelling on the back of his first section, and his latest development was 74 properties in West Auckland. David, with $300 billion of mortgages refixing this year, what are the implications?
It's really interesting because us Kiwis, we're often a little bit short-termist, because to have that much, 81%, that's 4 in every 5 Kiwis coming up to refix their loans. It's some big numbers. It's going to be really interesting because it'll see what's the Kiwis' buyer behaviour is going to be. We have been quite short-termist. The reality is we don't have the same number of options that we do in the States, where you can get 30-year fixed-rate loans, and they're actually relatively common to fix for 10 years plus. In Australia, they also have 7 and 10-year fixed-rate products. But us Kiwis, we like to be short-term, and we also took a bet, and that was the bet that the interest rates would go down. And guess what? The interest rates are going down. Perhaps they could go down faster. Can't change the past. It is what it is, but certainly the economy is having some challenges there. There's not much wage inflation going on. Inflation's well under control. So perhaps we're going to see a lot of Kiwis starting to take some fixed-rate options, but which ones will they take?
Yeah, well, I mean, when we were going through interest rates going from like 10 years ago from 6-7%, and then they took a dive down to closer to 2%.
Yeah.
And then, we all know what happened. They went from 2.5% up over 6%. So for a long time, rates were going up. People were spending more on their mortgages than they were used to. And now we're finally starting to see people probably coming off mortgages in that 6.5% range, going to be able to be fixing under 6%, even closer to 5% in some cases.
Absolutely. And in the months ahead, probably some of them would likely have a 4 in front of them, perhaps the 1-year terms initially, and then these rates are likely to come down as the official cash rate changes. I've got some 5-year loans that are taken out in early to mid-2021 that haven't come up yet. They'll be up in next year's one. I always have a slight concern that too many Kiwis often do shorter periods, or otherwise they go for just the cheapest rate, and that does frustrate me a little bit. I think that the more savvy investors should adopt, I guess, an interest rate averaging strategy, which is much like many savvy investors do in terms of dollar cost averaging strategies for equity investors. So my thoughts are that Kiwis will still look for these low rates, and they'll be chasing whatever terms that they are, and these may well be quite short-term ones.
Yeah, I mean, what are we expecting to see from the Reserve Bank over the next year or two, and how's that going to impact these investor strategies?
The Reserve Bank are surely going to lower the official cash rate in the next announcements as well. I was slightly surprised that they didn't drop it a little bit more. I think that the writing was on the wall and they could have taken some forward indicators into account. It's one of my frustrations with the Reserve Bank is that they do not do the inflation monthly like most other OECD countries do. They do it quarterly. So that CPI index, the Consumer Price Index, that drives the setting of these monetary policies, such as the OCR. And if they did that monthly, they'd be able to react a bit quicker, both putting it up and also putting it down. So if they did that, I think it'd be down a bit further by now, and that would take out some of the pain that many are facing, because the economy is still doing it a little bit tough. We need to really make sure that we've got the policies there for businesses that, after all, employ people and are responsible for the production. We need to support the business owners so that they in turn can keep firing up the economy. Our tax base is suffering a little bit of erosion because the economy is not so great. So these returns to productivity will help, and by not having such fiscal drag, it'll encourage businesses to spend money. CapEx, capital expenditure, it becomes easier. It becomes easier to borrow, and you become more confident about it when you have lower interest rates. So it's a helpful thing, and I think that the Reserve Bank governor should have lowered the interest rates a bit more already and should have done them faster. But I think that it's pretty confident that they will be lowered in a measured fashion over the coming months.
In terms of using interest rate averaging, how do you think about it with a bigger portfolio?
Yeah, absolutely, because it's important to not have all your debt coming up in terms of repricing at the same time. That can be quite risky. So if there's an obviously good rate, such as those April 2021 fixed rates at 2.9 something for 5 years, it might be good to go overweight in a rate that's just so fundamentally good, because how much upside could it have been? Could the interest rates have gone lower? Some people thought so they would fix for shorter terms there and take a 2.15% 1-year rate or things like that. However, that you can take a lot of the gamble out of it by doing this interest rate averaging, and you could put a portion of your debt. You don't have to be scientific and split them into sixths and say 1/6 floating, 1/6 that won't fix for 1 year, fix for 2 years, 3 years, 4 years, 5 years, for example. That way it can be a little bit brutal, and if you're just doing it on one loan, that's a little bit of a pain for your banks and brokers, and quite frankly for yourself to do in terms of the multiple accounts to administer. But you should have your portfolio in mind, and you should actually put down in your schedule when your debt's coming up for repricing, so you can actually measure it and measure the expiry. And that's something there that you do very well at Mortgage HQ with the advisory team. You put the financial advisors have this great software where you're able to have the debts all loaded up, so you know when it's up for pricing, and you can encourage clients to have this interest rate averaging strategy to do it. So you might want to not have everything now in 2025 coming up in 2026. You might want to consider some 3-year rates, even if they might be 0.4% higher. Suck it up there, take some of that risk out of it, because it's going to be safer for you. It can limit what's downsides, and indeed it does take out the upsides, but it's your own way of having a more stable interest rate over time. It served me quite well. When the rates are so obviously good, then you go hard and go overweight on something like the 2.95% for 5 years in 2021.
Yeah, obviously you get a little bit more optionality if you're fixing everything short term. It means if you sell the property or change your ownership structure, you're not going to hit with bigger fake fees. But if you're sure about your properties and your plan and your ownership structure, the interest rate averaging provides the certainty.
Absolutely. I'm not a financial advisor, and obviously we in these interviews only ever give generic financial advice. But the reality is that for some people, they know they're going to sell it, or they know that they may need to relocate for their job, be called into the Wellington office, the Sydney, Melbourne office, or whatever. So that's not the best, because you incur big break fees on doing that. But for so many people, many professional investors are in it for the long term. They want to be the best accommodation service providers they can be, so they may well consider potentially even fixing for slightly longer when perhaps in conjunction with their financial advisor, they can realise that these rates do look fundamentally pretty good, and perhaps they could skew that if they can get a decent deal out of it and fix for a little bit longer.
Yeah, I mean, certainly with the banks these days, they do make it very easy to refix your home loans through the app. They'll send you a text or an email, give you a phone call, and make it very quick and easy for you to make that decision on the phone. Certainly wouldn't suggest avoiding that, booking a conversation with your advisor, going through the process of just double checking that you're making the right decision, and pulling out the spreadsheet and updating and just making sure you've thought about it a little bit longer.
Absolutely. It also gives the opportunity to have that conversation with your advisor about, hey, am I still doing the right thing? Am I still right to be with this lender? Maybe I need to change lenders because I can get better terms from them. So it's all those things can come up in the conversation. It's really important to keep reviewing where you are. And of course, each time the loan comes up in terms of its pricing, it's just a good time to pause and reflect and take the best steps for you and your family's financial future.
Yeah. And how do you think New Zealand differs from Australia in terms of the market stability, given that New Zealanders really do focus short term with their mortgages?
It does frustrate me. So it means that the OCR takes more of an impact as well. So when many people are on floating or 1 year fixed rate or 6 month fixed rate terms, the OCR is going to have some meaning for it. It's going to be able to make some change. It's a big lever. Whereas if you've got your debt fixed for longer terms, it's a lot harder to change the settings. So that's one thing that can be good. However, it can be risky as well, because a lot of people got hurt when the interest rates got put up in the wake of COVID as well, when the Reserve Bank government said that the rates would be kept at a low level for a long time, and then went back on that. and he had to be honest. But that's certainly it caused a lot of people, unfortunately, its ways slightly unpopular amongst many homeowners and indeed investors, because these didn't keep to his word, and they still don't like what he's done, irrespective of their political preferences. There are people from both sides of the spectrum that are annoyed with him for doing that. However, he had to do it. So the OCR, with our short-term focus that we have as Kiwis, will have some more bite. It means that people will be able to get that money in their pockets faster because the interest rates will be lower, so they'll have less outgoings to service their loan.
Yeah, and so if inflation does stay high or go up again, then what will happen?
That depends. Hopefully they will heed some of my advice and to consider an interest rate averaging strategy, to have not just everything at floating 6 months, 1 year, and consider some longer rate terms. So then the OCR, when it gets put up eventually, and of course it's highly likely to come down rather than go up.
It will come down over the next 12 months. That's what most people are predicting. But I even saw BNZ released to say that they expect it to go back up again in 2026.
Next year, yes, absolutely, and others said in 2027, and it's crystal ball gazing, the whole thing, and that's why the interest rate averaging strategy works, because then you can take the risk out of it. It's not a gamble; it's your way of leveling up the interest rate and the shocks from doing that. It would require the economy to recover and for inflation to start increasing again. Let's see what happens there. There's a few things that are at play as well. There's a change in government just in a few days' time in the US as well. Will tariffs come in? Will they have a material difference? Probably not, but they're not an absolute major trading partner here. So it'd be really interesting to see what the global economy has in mind for us. But New Zealand still is, we're heavily reliant on our primary producers there, the agriculture, aquaculture, etc. Sector. So we've got to really, really focus on doing that. Until we change a few other levers, we'll find it hard to get the full large-scale production, sort of like the Irish economic miracle.
Yeah, well, fingers crossed that some government in New Zealand can figure that out. Now, coming back to the interest rate situation, I guess the philosophies I think about is try not to make money from your interest rates. You make money from smart property decisions and intelligent mortgage structure.
Yeah,
some
absolutely.
people really fuss about getting the best interest rates, but then they have this large portion on floating that they don't address year to year. So they're losing money by having way too much floating and not paying that amount down, or using revolving credit properly.
Using revolving credit, it's fantastic there for the summer holidays to Noosa, and then it's fantastic to go for the ski trip to Aspen. That's a pretty cool way of using your revolving credit, and you should always make sure that you have a really cool car, because in 5 years' time, then you can congratulate yourself on that 6 figures that you've lost on that car, but at least you felt cool. So that's something there that unfortunately too many people do, is self-sabotage there as well. For some people, they actually need that to give themselves that boost up there, and that's okay. So I try not to judge them too much for it there as well, but there are actually some really good people there that drive normal cars, that don't go on holiday in Aspen and go to Noosa all the time on their revolving credit. And some of those people there are on more humble incomes and have 4 properties and get themselves a huge 6-figure passive cash flow.
Yep. So it's just making sure you're intelligent about the right things. Nitpicking on the interest rate is okay, but it's a bit silly if you're doing structural things incorrectly. That's costing you more.
Absolutely. That'll cost you more than that 0.15% discount that you're sad about doing. Sometimes changing banks for the sake of it isn't necessarily the smartest policy as well. It's something you need to chat to your financial advisor. Often you can do better by actually having a plan in place to figure out, hey, how can I grow my portfolio? Have I got it positioned in the right way? Am I able to do some additions, alterations, maybe some new builds on it to help transform it? Because the fundamentals of property investment is surely cash flow, equity, and growth, and you call it the 3 C's strategy. If you can actually focus on getting a positive cash flow, having more money in your back pockets at the end of the month than you had at the start, having an increase in equity, those are some really, really fantastic things to do that'll make some meaningful changes. And if you just do that step by step over time, you'll do extremely well and set yourself and your family up for a great financial future.
All right, thanks, David. If you've got any questions, leave them below, and don't forget to subscribe.
Financial freedom. Financial freedom. Oh yeah.